So I wanted to do a quick demonstration of how anybody can save quite a bit of money by paying off a mortgage more quickly than what's just called for by the monthly payment. So what I have set up here is a spreadsheet where we're going to enter an amount of principal, an interest rate, the number of years, and it's going to do some computations for us, and then we'll be able to manipulate this and see how some small changes can make some pretty big differences in the long run. Now, this is only going to apply to the mortgage that you take out for a house, but it does, the concept still works for a car loan or any type of loan you might have. This does not reflect, though, any down payments or closing fees or anything like that that might be associated with it. So this is strictly just dealing with the mortgage. So let's say over here for our principal that we borrow $200,000 for a house, for our mortgage. And let's say our interest rate is 5%, and we take this out for a 30-year loan. So you can see now that a lot of different values have been computed here. And what I have right here at the top is this is the original or the total amount that you will pay back if you only pay the monthly payments every month for the course of 30 years. So you borrowed $200,000 and you're going to end up paying back $386,511. This value right here will not change as we manipulate the items in our spreadsheet. This portion right here, though, will change as we make some adjustments to our sheet. Okay, so I have the total that's being paid, and then I've also separated out how much of that total is interest, because we still have to pay the $200,000 back that we borrowed. So the interest is the extra amount that we're paying to the bank, essentially for borrowing their money. It's the excessive. So this part right here, though, I have the total amount we pay back, and then I also have it separated out into how much of that is interest, because we do have to pay back this $200,000 that we originally borrowed, but the interest, that's the extra that we're paying to the bank because we are borrowing money from them. So in my sheet here, I have the month that we're making the payment for. I have the beginning principal balance for the month. I have the amount of interest that's owed. And then I have the monthly payment. And then I put a column right here for an extra payment. And then I have the ending principal. So what we're going to do is we're going to just do some manipulation to this extra payment column. And it is assumed that these extra payments are going to go directly to paying down the principal. So if this is something that you decide you end up doing, make sure that you are explicit that this extra payment goes towards the principal, not towards the interest. So let's say that you decide from month one, you get your mortgage, and you decide that you're going to budget an extra $100 a month for an extra payment towards that principal. Now, this doesn't mean you would have to do it every single month, but if you try to budget that $100, then you will probably be more consistent with it. So what we're going to do is we're going to say that for the first 10 years of your mortgage, you're going to put in an extra $100 every single month towards that payment. So that would take us to 120. And now, when we've put in that extra amount, you'll notice that our original total here, that $386,511, that hasn't changed. But this has changed. So what we can do now is we can compare what we would have paid back to the bank without doing any extra payments, with just doing our monthly payment, versus now what do we pay to the bank. So you can see right here that by doing that extra $100 a month for the first 10 years, that's going to save us $27,000 over the course of the loan. Now, you could extend that to a longer time and it will continue to increase your savings. Let's say you're not comfortable doing that $100 a month, but let's say it's tax return time. And you decide you're going to take your tax return and you're going to apply it to paying off your mortgage, which is a great idea. So let's say that your tax return comes halfway through the first year, and let's say that you have $2,500 of your tax return that you want to apply to it. And let's do this for 4 years. So there's our first year. Here's our second year, and I'm just going to put in $2,500 each time. Third year. And our fourth year. So you do this for the first 4 years of your mortgage, and notice that with just those four payments that would hopefully coincide to your tax return, you would be able to save $27,000 over the course of the loan. Now you can do all sorts of different things here. You could pair them together. Maybe you want to do those $100 extra every month. Whoops, that didn't work. There we go. All right, I'm going to go back down for 10 years. So you want to budget, $100 a month for 10 years. But those months when you get your tax return, you want to put that whole thing towards it. So let's say that your $2,500 is there. There's your second year. Oops, there's your third year. And there's your fourth year. So with that, you'll notice that our amount has increased now to almost $49,000. So there's all sorts of different things that you could do that would really potentially make a difference here. What I want to show you, though, is how making these payments early in the life of your mortgage has a much larger benefit to the amount that you're going to save. So I'm gonna simplify this. Let's say in month number 1, I make an extra $5,000 payment. Okay, that is going to save me $16,381. So try to keep that number in mind. Now I'm going to delete that $5,000, and let's say I don't make that payment until, how about right here, the 240th payment. So that would be after 2 years. So same $5,000, or did I say 20 years? But 20 years later, notice that's only going to end up saving me $3,000, which is still good, but it's not as good as the $16,000 that we had originally. Now, the reason that occurs is because when I make this $5,000 payment way up here in month 1, it saves me interest every single month for all of these 20 years. And that's what then adds up to saving me that $16,000. When I don't make that extra payment until later in my mortgage, it doesn't have as much time to save me money, which is why my amount is smaller. But again, saving $3,000 is still better than nothing. So there's all sorts of different scenarios you can do, but ideally, if you are in a position where you have a loan, whether it be for a mortgage or something else, if you are able to make extra payments towards that principal amount, you can save yourself substantial amounts of money over the course of time, especially if you're doing something like a 30-year loan. So it's just something to keep in mind, maybe something to look into. Talk to your bank and see what you can come up with to save that money. The one thing I did forget to show you is when you do make these extra payments, so let's say I did my $5,000 here, you will also end up paying the loan off sooner. Okay, so with that one extra $5,000 payment, you'll see that I make my last payment, let's see, not quite 2 years sooner than what I would have originally. So instead of having to pay for the 30 years, I end up getting done about 2 years sooner. Okay, and that's also one of the benefits of making these payments. Not only are you potentially going to save yourself a lot of money, but you'll also be done paying it off much sooner. So that's all I had for this demonstration. Hopefully you were able to pick up some different ideas, and maybe you'll be able to try some of them out.